Business Finance, Chapter 16. In Chapter 16 and 17, we're going to talk about short-term asset management. So we start Chapter 16 by looking at net working capital and reviewing net working capital from previous chapters. So we know that net working capital is current assets minus current liabilities. So we can look at how net working capital plus fixed assets equals long-term debt plus equity. So these equations are just different ways to rearrange that net working capital information. Therefore, cash equals long-term debt plus equity plus current liabilities minus current assets other than cash minus fixed assets. So we're going to talk a lot about cash management in Chapter 16. So how do we get it? What do we do with it? How do we get it? We can increase long-term debt by taking out loans or issuing bonds. We can increase equity through the sale of stock. We can increase current liabilities. We can decrease current assets, such as receiving accounts receivable, cash for accounts receivable, or cash for the sale of inventory. And we can decrease fixed assets by selling off property, plant, and equipment. How do we use the cash that we have? We use it to pay off debt, to buy stock back from the marketplace, to pay off accounts payable and other short-term expenses and current liabilities, to increase current assets by buying inventory for future resale, and by buying property, plant, and equipment. So we're going to talk about various components of current asset management and current liability management throughout this chapter. One of the things we discuss is the operating cycle. The operating cycle is the total amount of time it takes to receive inventory, sell it, and collect cash on the sale. We take the inventory period, add the accounts receivable period, and that is the operating cycle. So we calculated inventory period and accounts receivable period in Principles of Accounting 2 and also in Chapter 3 when we talked about financial statement ratios. So the inventory period is the time the inventory sits on the shelf, and accounts receivable is the time it takes our customers to pay us after a credit sale. The inventory period we know is the 365 divided by the inventory turnover, and the accounts receivable period is 365 divided by the receivables turnover. You should recognize all of the equations and terms on this slide from Chapter 3 from our financial statement analysis. So we look at cost of goods sold divided by average inventory for the inventory turnover, and credit sales divided by average accounts receivable for our accounts receivable turnover. In addition to the cash or the operating cycle, we also have what's called the cash cycle. So the cash cycle is the time between when we pay for inventory and when we receive cash for the inventory, or the total operating cycle minus the accounts payable period. So how long does it take us from when we order inventory on credit until we pay off that liability? The cash cycle measures how long we need to finance inventory and receivables. So for example, if we have a period of time between when we have to pay our inventory or accounts payable and the time when we receive cash for our accounts receivable, we might have a period of time where we need to borrow money in some way, shape, or form. And we're going to talk about the different ways that we facilitate that coverage of the cash cycle. The cash cycle is the operating cycle minus accounts payable. period. The accounts payable period is 365 divided by the payables turnover. And the payables turnover is cost of goods sold divided by the average account payable. Remember, this assumes that the only things in account payable are inventory purchases. We can see now a timeline of the entire operating cycle from when we purchase inventory until cash is received on the inventory. And then the cash cycle is here where we have to pay cash for our inventory, and the difference between when we pay that and when we receive cash for the sale of inventory. The amount of time all of this takes is something that managers are very focused on, because if we start having an increasing accounts receivable period, then we might start having cash flow issues and liquidity issues. If we have an extending inventory period, that might mean that we're starting to have problems selling off inventory. So we start to look for issues within these operating figures. Who's responsible within a company for taking care of this information? Well, a variety of managers deal with these short-term financial planning things within an organization. We have an accounts receivable manager, credit manager, cash manager, the marketing manager, purchasing, production, payables, the controller. So all of these accounts are cash, marketable securities, short-term loans, accounts receivable, inventory, accounts payable. All of these managers actually work together within every single component of our operating cycle and our cash cycle. We're going to look at an example here. We have information from a balance sheet and an income statement. So we have information about inventory, accounts receivable, and accounts payable. We also have the net sales and the cost of goods sold off of the income statement. It doesn't say anything about some of the sales being received in cash and some in credit, so we would assume that 100% of sales are on credit. So we're going to calculate the operating cycle, which first we need to calculate the inventory period and the accounts receivable period, and then we can look at the cash cycle. So we're going to look at the information here. So we have our average inventory is beginning inventory plus ending inventory divided by 2 gives us our average. So we have our average inventory and our cost of goods sold. So cost of goods sold divided by average inventory equals 3.28 times. That means on average, we turn over our entire inventory 3.28 times a year. We use that number to calculate the inventory period. So we take 365 divided by the inventory turnover, and we get 111 days. On average, our inventory sits in a warehouse or a parking lot or on a shelf, depending what kind of business we are, until it is sold. And then our receivables period, our receivables turnover is 6.39. That means we turn over our receivables into cash 6.39 times a day. It takes on average 57 days for our clients to pay us cash after a credit sale. Therefore, with a 111-day inventory period and a 57-day receivables period, our operating cycle is 168 days. Whether that is good or bad really depends on our industry. Some industries have very long operating cycles as the nature of their industry, and other industries have very short operating cycles. So this would be one of those things that you would want to benchmark against other companies in your own industry to determine whether you were doing a good job or not. And now we can use that same information to find our cash cycle. So the cash cycle is the operating cycle minus the accounts payable period. So we have an accounts payable period of 39 days. So we pay off our payables 39 days after we place an order. So we have a 129-day cash cycle. That means that our inventory and our receivables must be financed in some way for 129 days. We have a 129-day gap between the time that we purchase inventory and the time we receive cash for it. There are two different main types of short-term financial policy, and we can have a lot of variety within them, but the two overarching are a flexible policy and a restrictive policy. A flexible policy means that we just keep on a high amount of cash and marketable securities so that we always have cash available for any event, especially to cover that cash cycle. We also carry high levels of inventory. We have liberal credit policies and a very large accounts receivable. And we have really low levels of short-term liabilities. Firms with a flexible policy have a lot of high liquidity. There is risk with this though, because what happens if we can't move inventory or our inventory gets damaged, or the more liberal our credit policies, the higher risk that we might suffer from bad debt exposure. So there's a balance to what is the best. The restrictive policy means that we have low cash and low inventories. We do little to no credit sales, so we try to push as much cash as possible. And we have relatively high levels of short-term liabilities. So in this example, we use the short-term liabilities to cover that coverage area. Companies with a really restrictive short-term financial policy have lower liquidity than companies with a flexible policy. So what are the advantages and disadvantages? Well, for a flexible financial policy, the advantages are that we don't have any difficulty meeting short-term obligations. We have cash available for emergencies. We can get economy of scale with our storage costs. If we carry a lot of inventory, we might be able to use a warehouse. Disadvantages are that if we have a lot of cash, we're not investing that cash and earning interest on it, so we're not getting as much of a return. And we might run into an area where we're financing short-term assets with long-term debt, which is a risky proposition. And for the restrictive financial policy, advantage are that we are investing that cash in marketable securities. We have higher returns because of those investments. We have lower carrying costs, and carrying costs are costs of keeping inventory, so storing inventory, managing inventory, having insurance on inventory, and our short-term liabilities can be decreased easily in case of an economic downturn. Disadvantages are that we have higher liquidity for emergencies, and we have higher storage costs. So what are these different things? Carrying costs and storage costs. So carrying costs are the opportunity costs of owning current assets versus long-term assets that pay higher returns. So we either have, it's the cost of storing large amounts of inventory. Shortage costs are order costs, so the cost of ordering additional inventory or transferring cash. We might have fees every time we transfer cash, so if we don't have it on hand, we have to pay for that. The order cost, so we have to pay for delivery, shipment, etc. every time we place an order. There's a cost for placing orders. And then we have stock out costs. Stock out costs are the cost of lost sales due to being out of inventory. And if we have a regular stock out of something, we're going to long-term lose that customer. If we have a one-time stock out, it's possible that that customer is going to pick a substitute item or just go to a different store. But if they continue to experience stock out issues, they'll just stop coming to where we are.